Hi, traders. Welcome. Welcome once again, traders. Welcome. Welcome to another live Q&A session with Oliver Velez. Of course, my name is Oliver Velez, and there's something I never want you to forget. I am your trader for life, or at least I hope to be. Welcome once again, traders. I'm so glad you're here. I'd like to thank all of you for attending these live sessions. I try to have these live Q&A sessions here every single week. Some weeks I'm not able to do so, but this week is not one of those. So, welcome. Happy Memorial Day holiday for those of you who celebrate that from the United States. But I'm so glad that I'm so glad that you're here. Why don't you very quickly let me know where you're coming in from? That'll be a good way to start. I like to give everyone a few minutes before we get started to sort of get settled. Grab something to take notes with. Grab the beverage of your choice. I have some iced tea here. All right. Love you too. Love you too, guys. um, so I'm hoping to have another dynamic Q&A session here today. I do want to let you know that I do plan to extend some of these or add to some of our live sessions here. So I want to have a live technical analysis day assigned to the week. That'll be the next step that I take for the channel. So we will not only have live Q&A day, which is typically on Monday, but we're going to have live technical analysis Thursdays. All right. That's going to be coming up soon. So be on the lookout for that. And this is where we will basically spend um, one day a week covering something of technical value for you in your trading so that every single week you can build upon your technical know-how, your technical expertise in the markets. You know, what's really interesting is that when I first started trading in the business in the mid 1980s, no one used technical analysis. Everyone thought that it was hocus pocus. I was actually one of the first. I was actually one of those first few traders that really relied almost entirely on the technical approach to trading. But what I used to actually explain to traders on the desk back then on Wall Street was that whether you think that you don't believe in technical analysis, but what you're really relying on is in fact technical analysis, because what they did was monitor order flow. So we basically were ticker tape watchers. We watched the prices of stock transactions go by, and we monitored the size of those transactions and the velocity with which those transactions were going by. We also would monitor the rate of change. So the rate of change in terms of size, the rate of change in terms of velocity. And it's those techniques of watching the order flow go by a ticker tape to monitor those changes. Well, what we essentially were doing, were monitoring the we were monitoring the individual transactions that would make up a technical bar on a chart. So instead of collecting all of those transactions and viewing them all condensed into a single bar, we were actually monitoring every single one of the transactions that would create a bar. So by so it was still a de facto technical approach to the markets. And this is what I would try to explain to many of the old timers on the trading desk back then, that you're a technician. You think you're not, but you're a technician. You're monitoring the technical part of the game, the transactions. And a lot of people don't understand the difference between a fundamental approach to the markets and a technical approach. I always believed in the technical approach because my definition of technical trading is the reliance on what is happening now. Do you understand this? The technicals point to the now. It does not project the future, but it does utilize the past to help you read what is happening now. You can use the combination of the past to help you determine what is happening now, to help you come up with a statistical model of what is likely to happen in the very near future from this now. This is technical analysis. Fundamental analysis uses past data regarding a company, right? With the idea that the past data should reflect in what should happen in the future. I believe that's actually more hocus pocus than the technical approach. There are many people in the game still today that believe that technical analysis is smoke and mirrors. They believe that looking at the markets from a technical point of view, they say drawing lines on a chart and moving averages don't really reveal anything. And that could not be further from the truth. I think that what's closer to the truth is that looking at a snapshot of a company 3 to 6 months in the past and taking that data, which is now old, and saying that because this company earned this and did this 7 months ago, the price should go here. I think that's more hocus pocus than saying, for instance, the last time Tesla tested $600, it exploded to $1,200. It doubled in price. So that the next time Tesla comes near $600, there should be some area of support. Why? Because traders were rewarded at $600. And we are repetitive animals, no matter whether we like that or not. And whatever we get rewarded from, $600, we will tend to repeat. So a repeat buying or going into Tesla at $600 is a high likelihood because that act in the past rewarded traders. That to me has greater reliability than saying, well, this company earned this over the last 3 months, and we project from that earnings that the price should be this. I think that's more hocus pocus than technical analysis. But anyway, guys, what a great opening, guys. My approach to the market has predominantly been technical all the way back from the days where the vast majority of people did not believe in technical analysis. I'm actually partly responsible for the street and for this industry relying on technical analysis in a big way because I became one of the biggest voices in this industry in the early to mid 1990s going into the 2000s before I sort of semi-retired. I was on every financial show all the time that you can possibly fathom. I was on CNBC regularly before CNBC was CNBC, when it was FNN Network, which became CNBC. I had one of the largest, most respected financial trading firms in the industry. I had over 88,000 institutional subscribers to my services, my analysis about stocks in the individual market. I had trading offices all over the world: Japan, Germany, uh, London. I had trading offices throughout the United States. I even had a trading office in Caracas, Venezuela, all the way back in the late 1990s, 2000, where we were the vast majority of the volume on the Venezuelan stock exchange. Um, and so during this particular time, my approach was technical, which was so anathema to what the vast majority of other traders relied on. And because of the popularity of my firm, because of the popularity of what we were doing throughout the world, all right, because of the popularity of my first book that came on the market, because the industry chose me to be the spokesman for the trading industry all the way back in the 90s, because Barron's ranked me and my firm the number one source to go to for institutions and high level individuals who wanted to learn how to play the market successfully and professionally, because Barron's ranked me number one in the United States, because Dow Jones Industrial Average named dubbed me the messiah of trading all the way back in 1998. I mean 1999. Because of these things, the popularity of my approach to the market, like swing trading from a technical perspective and day trading from a technical perspective, actually proliferated. Now, I'm not saying I'm the only one who helped to contribute to that, but I am definitely one of the major ones. So I tell you this to say this, guys. When we are together and we're talking about things, when I'm showing you things or teaching you things or we're discovering things together, these things that I'm sharing with you, they're not coming from a third party. This knowledge that I share with you is not coming to you because I've taken a seminar somewhere or I've read someone else's book, or I was the mentoree of someone else. This came from 38 years of living in the markets every single day of my life, nearly 4 decades long, losing, winning, going through major ups, major downs, and surviving, right? My pedigree is very rare in this space. It's very rare to find someone with nearly 40 years of trading experience and document it. You can go back and look this up, document it, that's still in this business. All right. So there you are. That is why I want to be your trader for life. I'm so glad you're here. Thank you for recognizing that, guys, and thank you for your support. I love the comments that I see persistently on the videos. I love the fact that many of you are starting to like the videos. I want you to understand that this content takes a lot of time to put out for you on these channels in 3 different languages. It takes a lot of effort. There's obviously cost associated with it. The way you pay me back is to like the video. And even if it's just a comment, great video, loved it, Oliver, or hated it, whatever the comment is, the comments help, the likes help. And whenever you don't like something, hit the dislike button. That helps too. All engagement helps. Okay. So subscribe to the channel if you haven't already done so. We have nearly 250,000 subscribers just on the English channel, one of the fastest growing, um, technically oriented trading educational sites on or pages or channels on YouTube today. And I'm hoping to continue my dream of basically leaving a legacy behind me of proper knowledge and information to give those who were just like me all the way back in the beginning of the 1980s who want to start in this game but don't have the resources to really start at a very high level. All right. And so I want this channel to be a place where everyone can come and start and get some sound information, some sound techniques, some sound knowledge, a sound foundation under their belt, and not have to basically go into this game blind as I was forced to do. All right, guys. Here we go. Remember, I told you that I take the majority of my questions, all right, during these Q&A sessions from my Twitter page. So, guys, I tell you, if you are not following me on Twitter, I strongly suggest that you do so. I'd like to pull that up for you, actually. Um, please follow me there. Now, I do use my Twitter page, guys, to be honest with you, just for Bitcoin oriented content. All right. I needed a space to just basically express my ideas and thoughts regarding Bitcoin, my most specialized, the most special asset as far as I'm concerned today. And so it is 100% now Bitcoin oriented. And so if that doesn't bother you, and I hope it doesn't, I do strongly encourage that you try to, let me see if I can get that up for you. Try to follow me there. I tend to take most of the questions that I use in the Q&A sessions from there. In addition to that, I am actually the most active there responding than any other social network at this current time. So if you're interested in maybe increasing your odds of getting a comment from me, a response from me, engagement from me, it is going to be here. That is OL Velez 007. Make sure you have the right page there. I have 21,600 followers. It's small, but it's quaint. I like it like that, actually. All right. So follow me there. And if you want your questions answered, that's where to basically ask me. You can DM me, or what you can do is ask your questions actually in the post regarding the live session as well. Okay. So without further ado, guys, let me start delving into some of the questions here that I received via DM on Twitter. Um, First question comes from Limo, who's saying, Oliver, hi, I am I'm part of your self-start trader program. My name is James. I entered your program about a year ago, December. My question is, how do I know the stock is between? Oh, how do I know? I'm not quite sure. How do I know that the stock is in between 75 and 200 with narrow bid ask spread. All right. Okay. I think what James is asking, guys, I suggest that my traders build a watch list. And this watch list must become their own personal stock exchange. There is a common error made amongst novice traders where they believe that the entire market should be their domain. How ridiculous is this? The world is yours in a way, but it is not yours to specialize in. You understand? The entire world of the market is available to you, but you must carve out your own market from within the broader market. And then you must specialize and become intimate and acquainted with your personalized stock exchange. This stock exchange, I tell my traders, should be no more than 10 on average and no less than six. That's right. Your personal stock exchange, if you trade equities, should be no more than 10 and no less than six. Now, this might surprise some traders because they're used to looking at, 200 stocks, 100 stocks. This is more of a novice approach because the New York Stock Exchange specialist trades one stock his whole career. NASDAQ market maker, which I was for 7 years, a NASDAQ market maker trades maybe three, mostly two. All right. If you get hired by a hedge fund, you're going to be assigned to maybe two or three things. You're not going to be told, okay, here's $50 million, knock yourself out, do whatever you want. So the professional approach is always the specialized one. It is never a look at everything out there. All right. Only novices do that. So when you focus and carve out a specialized list of things that you become so intimate with, it's like these things become your children. You begin to be able to predict with them with a higher level of accuracy because you live with them every day. Just like as a parent, you know when your children are lying to you, you know when they're sick, you know when they're happy, you know when they're a little sad, you know when something happened at school that bothered them. This is the same intuition you will begin to gain with your small stock exchange, that you'll become so intimate with them that you'll almost be able to feel when they want to go up, when they want to go down. You'll know how they react to good earnings statistically, historically, and how they react to bad earnings and things of that nature. And this becomes your edge. The professional has an edge on the average trader because the professional is in that stock all the time, and the novice is coming as a visitor for the first time. Who do you think is going to win? Who do you think has the edge? The one who lives in that stock every day or the one who's visiting the stock for the first time? Who do you think loses their money? The one who's the visitor loses their money. So you don't want to be a visitor. You don't want to trade something that you've never traded before. Before I trade a stock, I watch it for 6 months before I even have a chance of it being added to my universe and my worlds. All right. So what James is referring to is his stock range because I tell them pick a stock range. So his stock range is 75 to 200. Now, what he's saying, if my stock range is 75 to 200 and I'm going to carve out my personal stock exchange from that range, how do I tell if they have a narrow bid ask spread? Now, this is a good question because what I believe he's getting at is he wants to stay away from thinly traded stocks in that range where the spreads can go wide, which actually increases your risk. In one sense, it increases your risk. On the other side, it also can increase your profitability, but it does increase your initial risk when you're trading a stock with a bid ask spread wide, which means that if a stock is at 75 to buy but 71 to sell, you've got a $1 bid ask spread in between. And this means that if you buy at 71 and immediately want to get out, you have to sell at 70 because the next bid down from 71 is 70. But if the next bid down from 71 was 70.95, $70.95, your bid ask spread is only 5 cents. So you only lose 5 cents in that transaction. So he's saying, how do I tell? Well, what you want to do is you don't want to judge what your your stock's average bid ask spread is off the open, because typically off the open it's a little wider. You want to do it after the stock settles after the open. So anytime after 30 minutes, I'd say, is safe enough. So you want to take the average bid ask spread it trades at around 30 minutes after the open into the next 90 minutes or so. So eliminate the first 30 minutes and then watch your stock for 90 minutes after the first 30 minutes. Watch the bid ask spreads. It sometimes it'll ebb a little wider and ebb a little narrower, and then you'll get a feel of what the average bid ask spread during normal trading activity is. And if you have a guideline where I don't trade stocks that go beyond a, a 15-cent bid ask spread, if the stock is frequently breaking 15 cents, then you kick that out. That's not one in your list. And you limit to those that kind of in that period stay within that 15-cent bid ask spread range. And that's how you judge. But it's important to know that you don't judge it off the open, because the bid ask spread is actually stretched a little bit beyond normal off the open, and that can throw you off a little bit. Great question. Great question, James. Okay. Next question here. Uh, Hi, Oliver. My name is Carlos Alberto. I'm from your IFT family. I have a question. When I graduate from your IFT program, could it help me obtain an American visa? I am, I am, I am, I am Latin Venezuelan. All right. This is a good question. Now, it's going to lead me into a story. I'm going to try not to make this story too long. Back in the late 1990s, I opened up a trading office, as I mentioned earlier, in Caracas, Venezuela. And we had about 15 traders in this office that started to become a powerhouse in Venezuela. So much so that the stock exchange in Venezuela invited me to the country. All right, to celebrate my trading office's success there. They closed the Venezuelan stock exchange and had a party for me on the floor of the Venezuelan stock exchange. It was crazy. All the media outlets were there. I was interviewed by the two main media outlets there at the specific time. It was an amazing period of time. But as we started to move into the beginning of the 2000s, 2000, 2001, my traders in Venezuela started to become concerned with the political environment there. They started to begin to see a writing on the wall there that they did not like. And they started to impress upon me, Oliver, we believe that this should not be the place we should be. This is not the place we should continue to grow this operation. If your idea is to continue to grow throughout Latin America, you're using the wrong place to start, because I started with Caracas. They're saying what we see in the political environment is disturbing, and we believe we should relocate to a different place. And we use that place as the springboard to spreading throughout Latin America. Now, this is all the way back in the year 2000, all right, maybe late 1999, 2000. And so, what did I do? I took my 15 traders, I went through the process of getting them to the United States, their entire families, their brothers, their sisters, their mothers, their fathers. I took everyone out of Venezuela. I moved them to Miami. I put them all in apartments in Miami. I opened up the biggest trading operation in all of Florida, in Brickell, in the Brickell area of Manhattan, 47th floor, beautiful trading office. We could fit as much as 250 traders on the floor there. All right. This became my initial Latin American base. I used Miami as my intent all the way back from in the year 2000 to begin spreading throughout Latin America. There are many people who think that my involvement in Latin America is relatively new. They're wrong. They do not know the history. I had dreams and aspirations for penetrating Latin America with the gospel of trading, my style of trading, my approach to the markets, trying to change lives the way my life was changed in Latin America all the way back to the late 1990s. This is an older, maturing dream of mine. You are seeing, many people are seeing the fruits of those efforts today in Venezuela, through in various other parts of Latin America, Argentina, Chile, Colombia, all over today. But this has been in the works for a relatively long period of time, right? These things don't happen right away because of regulations and a whole bunch of things. So it was slow going, but some of the fruits are starting to bear, some of the things are starting to bear fruit now, where I have over 8,000 traders throughout the Latin American region right now. But anyway, all right. So the bottom line is that I did help those traders come to America, and I did support the process of them becoming legalized in America the right way through the legal process. I continue to do that in a selective way. I no longer have trading offices like that. But if I have a very talented trader who is in a country that he does not want to be in the country, I will help support that trader move to wherever the trader is. It is in my best interest to do that. If we are in business together and this is a money producer for the organization, why not? And especially if they're under some regime that makes it very difficult for them to enjoy the benefits that this act called trading, this act of freedom and independence, if the very act of freedom and independence cannot be expressed properly because of where they lived, then yes, they should leave. They should they should seek a different place where that can be expressed. And yes, I will help them. So yes, I will help you, Carlos. You got to get profitable if you're not already. All right. But you know the deal. All right, guys. Little bit of history there. Little bit of history there. All right. This is coming from Jenny. Oliver, not a good day yesterday. Um, I have not learned how to trade Nvidia. Nvidia is a stock, guys, which I've owned from $9.50, by the way. It reached as high as $600. But Nvidia, when it is going up and down, and Nvidia, by the way, is a very popular trading stock amongst a group of my traders because it is a high beta stock. Its volatility is nice. You can get big movements, and if you know what you're doing, volatility is a friend. And when you don't know what you're doing, volatility is an enemy. All right. So we love volatility, and NVIDIA definitely offers volatility. So I've not learned how to trade NVIDIA when it is going up and down a couple of points. I always lose on that. Anyway, I just wanted to share and I just wanted to share that. I'm kind of getting my confidence back, but it's not working today. I'm down $40. All right, $40. All right. All right, relax. It's only $40. But I will tell you this. The solution to a lot of traders' problem is actually inside of the question that they ask related to the problem. So what Jenny is saying is that, Oliver, I just haven't learned how to trade NVIDIA. I keep losing. So what do you think Jenny should do? Stop it. Stop trading NVIDIA. The answer's in your question. I listen, I keep hurting my head every time I bang my head against the wall, Oliver. I don't know what to do. What should I do? Stop it. It's just as simple as that. Listen, every stock is not yours. The same way I told you my father used to say to me at dinner. And I used to get sick of him saying this, Oliver, stop. Every dollar in the world is not yours. Stop chasing every opportunity you see to try to chase a dollar. You'll never get anywhere. You have to determine which dollars in the world are yours, Oliver. You have to determine where you put your effort. There's dollars everywhere. There's a sea of it out there, Oliver, but you have to carve out which ones are yours and laser focus on that. And so, if you've got a list of 10 stocks and you're keeping the proper records, you need to constantly determine which stock out of the 10 rewards me the most consistently, Which stock rewards me the biggest? Maybe not the most consistently, but I get the biggest gains from this one. Which stock is break even, more or less? Which stock gives me the most trouble? Which stock do I seem to hemorrhage money with? Well, here's something to think about. First of all, if you don't keep records like that, if you don't know where you're good at, what you're not good at, how do you know what to tweak and change going forward? That's impossible. So, record keeping this way, journaling this way is extraordinarily important. This is the key to your growth, the key to your constantly making the tweaks and changes that lead to growth and achieving higher and higher levels of proficiency in your trading, right? So, what also is interesting that I think is important to understand is that making progress is not always correcting something that's wrong. A big part of progress is just eliminating what is wrong or what is not working and accentuating what is. So, in this scenario I just explained to you, let's say you've got 10 stocks, you've got this one stock that's you just hemorrhage money in. For Jenny, it's Nvidia. I can't trade this whether it goes up or down. I lose all the time. All right, she's hemorrhaging money with Nvidia. It's easier to eliminate Nvidia than it is to try to make Nvidia work. It's easier to remove Nvidia out of your life than it is to basically work through and try to become good at Nvidia, which might take 8 months to a year of losing. Sometimes it's better to remove than improve. It's a very important point. It is easier to accentuate what you're doing good at than it is to improve what you're doing bad at. The first option is to remove it. Now, if you can't remove something, that's when you'll have to put in work to improve it. Like, for instance, I can't remove my second child, but I have the hardest time with my second child. I don't. I'm giving you an example here, right? I got the hardest out of my 4 kids, I got the hardest time with the second one. I can't remove the second one. Maybe I wish I could, but I can't. So now I've got to work on improving things with my second child. That's an example of I can't remove it. I got to work on improving it. But Nvidia, there's a sea of stocks out there to change. You don't have to force yourself to make Nvidia work. Remove that. Now you remove your headache, you remove the hemorrhaging of money. Now, where do you put the effort that you were putting into NVIDIA? That effort is now free to place where you put that effort into what is working. So you accentuate what's working, you remove what's not working. And when you can't remove it, then you hunker down and create a plan to improve what you can't, what's not working. And so this is what Jenny, if you're listening, this is what you have to do. For now, not always. Maybe one day you come back to NVIDIA, but it should be removed from your life right now. All right. No need to hold your progress back by making something work that's not working. All right. Good question. All right. I am not. I should be looking at your comments here. All right. All right. Let's see here, guys. Let's keep going. Um, Oliver, please guide me. My name is James. Oh, I think I took this question before. Sorry, got that. What is wrong with your eyes on your profile on Twitter? I believe this young lady is talking about my laser eyes. Well, Jojo, what happened to my eyes, if you're talking about my profile, is I took this orange pill called Bitcoin, and it just has this effect of making me laser focus on Bitcoin. And so that's the result of me being orange pills with Bitcoin. If you're asking me why I wear glasses all the time, because I always refer to guys, it's just because the light, my eyes are very sensitive to light. And this is the result of trading right? This is the result, guys, of trading for many years on monochrome screens. See, back in the 80s, you didn't have the nice, beautiful color LCD screens that you have today, right? These were the IBM big giant dinosaur like boxes, black screen, green lettering, and whatever. It just somehow affected my eyes in a way that just makes them sensitive to light today. All right. I'm very glad I don't need glasses, but I do have. So instead of it affecting me on a with a dimming of my vision, I think I have fairly decent vision for my age, but I do have this extra sensitivity to light, and I do attribute it to those years. All right. Um, Oliver, my name is Annie. I'm a social media specialist at Interactive Brokers. Um, would like to okay, that's a marketing thing, guys. Interactive Brokers, nice broker, guys. Give you a story about Interactive Brokers. The CEO and founder of Interactive Brokers was my neighbor for 19 years. 19 years. Um, I know Interactive Brokers, and obviously who formed it a lot better than most. He was my neighbor for 19 years. Good firm. Started out as an options firm, actually, by the way. All right. Oliver, nice to meet you. Encountered your book on sale in Japan. My trading life has changed. Thank you. Well, thank you very much. I can't read your name in Japanese, but thank you very much. Okay. Uh, yes, my guys, some of my books are written in 5 different languages: English, Spanish, um, German, Mandarin, and Japanese. Okay, Marcel says, Mr. Velez, I'm a huge fan of yours and deeply thankful for your videos. I would like to ask why you don't plot the open, high, low, close levels in your charts, since they are major support and resistance levels. I'm really amazed by the simplicity of your charts, and I really try to mimic, but I miss some landmarks in my charts. Many thanks. How to overcome this? Not quite sure what Marcel is referring to by not showing open, high, low, close, because every individual bar on a chart has an open, high, low, and close. So I'm not quite sure what Marcel is referring to. Also, I teach my traders to rely on the prior closing day's price along with the last high of the prior day, the last low of the prior day, and the final close of the day as reference points for the beginning of their trading day. So, Marcel, I think, is misunderstanding something because there is a great reliance on those points, especially off the open. As the day progresses, there's less reliance on data from the prior day because you have more and more data from the current day. So as the current day grows, the reliance on the prior day's data becomes less and less. The reason why at the open every day the prior day's data has importance is because there is no data from today yet. So the only thing we have to reference is the data from the prior day. But as your day grows and matures, as it starts to leave behind a trail of data, you begin to place more importance on the data from the current day and less importance on the data from the prior day. So Marcel is a little bit confused here. All right, here, guys, I'm going to try to breeze through these. Okay. All right, Oliver. One question for your Q&A scheduled for today. I'm a student in your trading camp. All right, thank you. I am making continuous progress, so thanks for all your support. Awesome. Here's a question: the volatility at the open, the first 20 minutes, is quite high, and it's a huge benefit today for trading the open. I'm just wondering if the volatility will always be in the opening, or is it a temporary phenomena? As you have more than 35 years of trading experience, what's your assumption about the volatility? We'll be happy for your feedback. Okay, cool. Thanks. Good question, Mohammed. Good question. So the volatility will vacillate between levels, obviously, throughout different market cycles. There are market environments that are more volatile than others. There are market environments that are practically devoid of volatility, which typically leads to explosive volatility later, actually. But the question is, the high volatility that we are enjoying off the open today, and we are, it's beautiful trading off the open today, guys. Wow. Will this continue forever? No. But will there always be enough volatility at the open to make a living? Absolutely. I've been making a living for over 30 years trading the open with different ranges of volatility. One thing you can be sure of is that the open is the most volatile part of the day. This is why historically traders did not trade the open. I was one of the first traders to basically institute that style of market play, which is to come out of the blocks in the first minute or two of the day. This was very odd for traders. In fact, it was against the rules in my trading firm back in 1986. All right. And I began to build my reputation as a trader who had this unique, very quick style of becoming profitable in the first 20 minutes of trading. In fact, my nickname was the 20-minute trader. And so it's this style that actually increased my notoriety on the street, that had traders that wanted to learn the approach, which led to me believing that I should actually start my own advisory firm. And that's how I left Wall Street to start my own business instead of working for a firm and being under, basically under the restrictions of my firm. And so um throughout my entire career, I have relied largely on the open for income producing trading, not wealth producing trading. It's a completely different style of market play, right? So there will always be enough. And the opening period, let's say that first 20 minutes, sometimes it's 30 minutes, that first 20 to 30-minute period is the most volatile of the day. And there's a reason behind this. It is because institutions deploy sometimes as much as 70 to 80% of their daily activity in the first 30 minutes of the day. So if they have a plan, let's say, to accumulate X number of shares of a stock today, that's the plan. The vast majority of that allocation will be made in the first part of the day. A good portion of it is often made in the latter part of the day, and little sprinkles of it in the middle. So the beginning of the day and the end of the day is the most active period of time for institutional money flow. Okay. And the middle of the day is the lightest. This is what I call the midday doldrums. The reason why traders have the greatest difficulty in the middle of the trading day is because that's when the institutional sponsorship in the market is at its lowest. The institutional sponsorship at its highest in the open, its second highest at the end of the day, statistically, and its lowest level, where everybody's basically lunching, in the middle of the day. There's lack of follow through a lot of the times. This is not all the time, but your day can be split into those three broad categories: open, middle, and end. And if you had to play the best times, you want to play what I call the market's bookends, right? So think of, you know, this thing holds one side of the books up and the other bookend holds the other side. The middle you want to stay away from. Trade the open, trade the close. If you had to pick one, I would say trade the open. If you can't trade the open, I would say trade the latter part of the day. Now, what am I calling the three broad categories? I call the bookends the first 90 minutes. That's a little bit beyond the open, of course, but the first 90 minutes, the last 90 minutes, those are your bookends. Anything in between is the sloppy period. Okay. So higher reliability in the first 90 minutes, higher reliability in the latter 90 minutes, lesser reliability of everything in the middle of those two 90-minute bookends. Remember that. I think that's very valuable. Okay. Um, okay. Let's see. All right, good question here. This question is coming from number one hodler. Okay. Hi, Master. What's the best way to pay yourself from trading profits? Should we take weekly profits or monthly profits? Now, in the trading, professional trading space, in the trading industry, it is historically, weekly payout has been historically the norm. Okay. And a weekly payout has been shied away from. Although in recent years, that has started to become slightly more and more, oh, shoot, what happened? Slightly more and more common. But I don't like with weekly withdrawing from your trading account. I do prefer monthly withdrawals from your trading account because a part of your trading monthly journey should be to first, in the beginning of the month, after your last payout, is to build a foundation for the month. Okay. And then after the foundation of profits are built for the month, you can start to trade a little more aggressive because you have a foundational profit layer. Now you go to bigger size, maybe trading higher alpha stocks, being a little bit more aggressive, adding more aggressively to your winning plays. If you build another layer, you can actually start to now play with even bigger size. And so you stage your month to a bigger and bigger month. All right. If you chop this process down to a week, you're not giving yourself ample time to build these layers. So you're stop and go because you're pulling money out and you're dropping back to zero again so fast. Now you got to start building a base again. Now, let me tell you when I was given the choice when I went out on my own. Now, I left the firm and I went out to trade on my own at first. Okay? I got two investors to invest in my trading career. They put the money up. I had a tiny bit of money to put up at the time. Okay? Um and basically I had a I had I started off with a certain amount of buying power in the account, right? Here was what I did. I had the ability to choose a monthly payout or weekly. Now, because I was young, because I needed to survive, all right, I had some savings from having been, um, decently successful, but I didn't want to really ruin that. So what I chose was a weekly payout. And what my partners gave me was the first $500 without any cut. So, meaning that my partners who funded my trading said, Oliver, the first $500 is yours. Everything else we split according to the money we put in. So, I primarily traded for $500 a week, basically. That was my that was my goal. I have to go home with at least $500 a week. This is going all the way back to the eight to the this is actually going back to the late 80s, early 1990s, right? So think of it this way. Um, what I had to do in order to secure my $500, I would start every Monday chipping away at the market. $40, $80, $100 here. Here's $200. Here's $120. Here's $90. Here's $50. Oh, this one's practically break even at $20. And I would just chip away. And I would chip myself to $800. I had to go past $500 to give myself a $300 cushion. You understand? I couldn't just go to 500 and stop because then I have no possibility of turning the week into a monster week. Then my weeks are always just going to be 500 if I stop. So I had to go past 500. So my initial goal was always to hit 800. Once I hit 800, I would never let the market eat away at my $500 because that was how my family was going to eat. You understand? So I had a $300 cushion. Now, in my mind, I'm playing with a $300 downside. With this $300 downside, I start chipping away to increase that cushion, getting more and more aggressive. And then, boom, Friday's here and I pull everything out. My partners pull everything out. Boom, I go back to ground zero and have to start again. Now, what this did was it increased my skill at coming out of the blocks and just instantly becoming profitable. Boom, 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 boom. I can do that with the best of them, right? It just made me better at that. But what it did was create a ceiling in my trading for a long time. For a year and a half, I battled going past a certain profit amount because I got into this mode of always going back to zero and starting again. If I had a longer period to build my base, my system, my trader DNA would start to get accustomed to building 800 first, 1200, 3000, 6000, 10,000, 12. You follow what I'm saying? If I had a longer period of time, but I would get to a certain point and boom, the money would come out and have to go back and start to zero. If you go to zero very quickly, you're going to train yourself to basically be a limited trader. You've got to give yourself the possibility of having those monster runs. And if you pull the money out so fast, you're limiting the ability to have those monster runs. Those monster runs in your profitability take you to brand new levels of growth, ability, proficiency, and professionalism. And you need those breakthroughs. There was a time where I had a $15,000 a day limit. I could not, every time I would approach a $15,000 profit, I would start to disintegrate. If I tried to break through 15,000, I would just start to fall apart. Now, a lot of traders experience this. You might experience it, but you might experience it at a much lower number. The number is not important. The fact is that I had a mental block at $15,000 in profitability, and I stayed there for a long time. All right. I started to think that, man, am I just going to be a $15,000 trader? That's it. I see traders and colleagues do 80,000, 35,000, 60,000. I'm going to just be a $15,000 trader. That's it. But eventually I broke through. But imagine if I'm always going back to zero, I would have never broken through that level. So there are traders that have a monthly payout and they don't even withdraw the month. They might withdraw some to live off of, but they leave the profits in so that they can keep parlaying the profitable level. Because as you keep building profitable cushions under yourself, you have earned the right to become a little bit incrementally more aggressive, which has the potential to be more profitable, but the risk can be absorbed by the thicker profit. But if you keep shrinking your profit base, you won't ever go to the next level. So I hope that makes sense. Number one, hodler. All right, good question. Javad is saying 15,000 and saying that's it. Oh my God, that's my 2 month goal. Well, yeah, but it's all relative, guys. It's all relative. So some traders have like I have traders that have this $300 block. Every time they get to 300, they get excited, and then everything goes to garbage. And there's one thing I hate, guys. If there's one you you can't really no, there's I was gonna say you can't piss me off if you lose. And you really can't. You can't piss me off by losing, losing, losing. But I see that you're losing correctly, then I don't care. I'm gonna talk about this for a minute because I think it's important, guys. Listen to me carefully. I don't care if every single trade is a loss, if it's a good loss. Because a good loss is not a loss to me. All right. A loss is not determined by money. A loss is determined by truth in your actions. A loss is determined by whether you were true to yourself, true to your plan or not. If you broke your rule, that's a loss. I don't even care if you made a fortune by breaking your rule. You lost in my book. Loss is not denominated by me in money, nor is winning. Winning, this is a game beyond dollars and cents. This is a game of being true to yourself. This is a game of being disciplined, being able to keep your word, being able to do what you said you were going to do. That's winning in trading. That's winning in life. That's winning in your relationships. That's winning as a human being on this planet. It is not anything about dollars and cents, right? So if you are being true to yourself, if you are being true to your trading plan, if you are doing the right thing and every single result is a loss, you're a winner in my book. I say keep going. Don't stop because I know that can't last. The right thing has to eventually take over circumstances. Do you understand? You can't keep doing the right thing and getting the improper result. The universe does not work that way. It eventually, if you don't stop, it'll eventually swing in your way. And it's going to swing in your balance in a powerful way because it's been held back so long. Because you have put the universe, as it were, in your debt. Because the universe held back the reward from doing the right thing, that reward got bigger and bigger and bigger. And boom, when it was time to release to release all that was pent up, you start to win boom 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 in this incredible way because it was held back by you constantly doing the right thing. So it's important not to use dollars and cents to determine whether you win or you lose. I don't care about the dollar amount. I care about the actions and how true you are to your process and your word. That's very important to understand. All right. I actually forgot where I was going with that, but that's good enough, I think. That's good enough. A lot of traders are focused too much on the dollar amount, but that actually is a byproduct of doing the right thing. It is not the thing to focus on. The focus, the thing you focus on is getting the actions right and not deviating from that, not letting the temporary contrary circumstances make you abandon the right action. Do you understand? People who chase money will abandon their principles, will start to do the wrong thing. You understand? They will be enticed to leave their post, to violate their promises and their word because just because by keeping their word right now, they're seeing no results. They become slaves to money, slaves to the result, and not appropriate disciples of the right thing. and you can't fall into this trap as a trader. Now, you have to know what the right thing is, and let's face it, a lot of traders don't even know what the right thing is. So you've got to know what the right thing is. All right, that's my job to teach you the right thing, but you've got to stay true to that. All right, and I've always told you that trading is like a microcosmic version of life. The market is life itself, and you are a participant in the market like you are a participant in individual in life. And the same characteristics that are required to be a good trader are the same characteristics that are required to be a good person, a good human being, a good father, a good mother, a good member of society, a good worshiper of your God, a good anything, a good team player, whatever. Um, it's no different. You know, the skills that you build as a trader, those skills don't really have a direct link to money. They have a direct link to you being disciplined, to you being able to know when it's time to abandon a thing or when it's time to double down on a thing, when it's time to give your loyalty to someone or when it's time to cut that toxic person or relationship out of your life. Aren't these the same skills in the stock market and trading? Knowing when to stay loyal to a trade, not abandon the process, when to cut it short and run for the hills, when to double down and add to it, when to minimize your risk, when to cut this out of your life and move on, when to end it and give it one more chance. Doesn't this sound like skills that you want your children to have? Isn't this aren't those the same things that an entrepreneur starting a business should be skillful at? There are times to quit. I don't buy this concept that never quit. No, you better quit. It is dumb not to quit sometimes. Don't let these basic ABC kindergarten Instagram platitudes motivate you. Never quit, never quit. Are you kidding me? All right? You should become an expert quitter. Just don't quit the wrong things. Quit the right things. If smoking is a problem, quit. Be a quitter, right? If your diet is causing you health problems, quit eating bad. Be a quitter. You've got to be a good quitter in life. You're you you're you're hemorrhaging money trading Nvidia off the open. Be a quitter. Quitting is an important part of life. We have to be a quitter. If your dream of becoming a trader is starting to hurt someone else that has nothing to do with your dream, you have no right to do your dream then. Everyone has a right to have a dream, but your dream cannot infringe on the well being of another. And if your dream to be a trader is starting to hurt another life, another human being, then I am telling you, it is time to quit, at least for now. You have no right just because you want to buy stocks and sell stocks to hurt someone else. And so there are times to quit, guys. You just have to be artful with quitting. Don't quit the wrong things. That's the lesson. But yes, be a quitter. Absolutely. Um, Oliver, Mauro's asking, Oliver, your opinion about this economic recession could affect the accumulation of Bitcoin. Will Bitcoin drop more in price? Well, I will say this that the macro effect on all asset classes is very palpable. So we went through a period of everything being a bubble. It was an everything bubble, right? Everything mushroomed. And what's happening now that the bubble is being popped a bit, or the excess is being taken out of the balloon, as it were, All assets, including Bitcoin, are being affected to the downside. You've got options. I mean, you've got stocks going down, you've got bonds going down, you've got cryptocurrency assets, including Bitcoin, going down. You've got things like gold and silver going down. Um, and you've got some commodities that obviously aren't going down in this inflationary environment. But for the most part, you've got the entire global classes of assets are negatively being affected here. What's interesting is that Bitcoin is not being affected as many people expected it would for an 80 vol asset. Bitcoin is an 80 vol asset, but if you look at things like Peloton is you can look at things like Peloton and Facebook that are down more, or Meta that's down more than Bitcoin. You look at things like Baba, it's down more than Bitcoin. You look at things like PayPal, down more than Bitcoin. You look at many things in certain sectors in the market are down more than Bitcoin. There's close to 30 plus percent of the S&P 500 is more volatile than Bitcoin. This is surprising, increasingly becoming more and more surprise. It's more and more surprising the institutional market, which is starting to increase institutional demand for the asset class right now. And so we're seeing a lot more stability in Bitcoin. Could there be lower prices? Absolutely, but I believe the lower price to the downside is limited. If you're a shorter now, you're an idiot. I'm just sorry. I have to say it like that. If you're playing Bitcoin for 3,000, 4,000 points to the downside, when this is an asset that can mushroom to $200,000 to the upside, you're an idiot. You don't know basic math. This is an asset that's already down 60%. Where do you think it's going? A zero? No, that's not happening. So if you just look at it from a probability perspective, it's better to bet on the long side and to average in on the downside it- than it is to take the small change that's possible on the downside. That's ridiculous. You have a 60-story building, all right? The ball is all the way down to the 10th floor. From 60, you drop the ball to the 10th floor. So you know that the ball's not going to go to floor one or two. That's probably out of the question. So now from 10 to 3, from floors 10 to 3, there's a possibility, but still low. From 10 to 5, a greater possibility, but still not great. But 10 to 6, 10 to 7, a higher possibility. But you're going to take that versus the possibility of going back to the 60th floor. The numbers, the math doesn't work that way. I swear people in this game don't understand basic arithmetic. All right. When when you're down 60% in an 80 vol asset, which means that you got 20% more to go historically, if that. Okay. But there's this asset has an average annual gain of 213%. So think about this. You've got 20% possibility more downside, but the statistical annual average to the upside is 213%. 20% versus 200%. Which side do you want to bet on? The 20%? If you do, you need to go back to grade school. This doesn't make sense. So, whatever the macro environment has for us, I believe the downside in Bitcoin is limited. I believe that we are approaching generational buy opportunity area. That I believe that when I talk about generational buy opportunity area, that that for for many years after, people will be talking about the people who buy in this range, in the mid $20,000 range, low $20,000 range. I think people are going to buy. People talk about when I got in the markets, Oliver, I wish I got in the markets with you at 3,800, $4,000. People are still talking about that now. This is going to be the range 2 years, 4 years, 5 years that people are going to be like, I wish I got in at $20,000. I wish I got in at 22,000, 24,000, 25,000, 30,000. This 30,000 is the new 3,000 from 2 years ago. And maybe 80,000 is the future 330,000. And maybe 150 is the future 80,000. I mean, this is Bitcoin's history. And you've got to be able to eliminate you can't you have to be able to eliminate the freaking noise in this industry, guys. And you've got you've got to understand that Bitcoin is the safest thing to hold. The volatility is not Bitcoin's volatility. The volatility is the dollar's opinion of Bitcoin. So when you see the price of Bitcoin going up, that is not Bitcoin going up and down. That is the dollar's opinion of what the value of Bitcoin is. But the dollar's opinion is not truthful most of the time, even on the upside. Sometimes the dollar's opinion of Bitcoin is too high. Sometimes the dollar's opinion of Bitcoin is too low. It's not Bitcoin that's volatile. It's the dollar's opinion of Bitcoin that's volatile. And it's not the dollar that is safe. It's Bitcoin that is the safest thing on the planet. And more people will realize this. And let me give you a very quick example of this. And then I've got to go. Why is Bitcoin safer? Because Bitcoin makes everything go to zero over time. And let me explain this. I was just talking about this earlier. So let me do this, guys, if I can here. I see that I lost a connection here at one point, but I regained it. Da, 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 da. All right, let me pull up a chart here and I'll show you what I'm talking about. Okay. Okay. Boom. Let me make sure I'm going here. Here, what you're looking at here, guys, is you're looking at a weekly chart of Bitcoin. The red line is the 200 period moving average, which it has never violated in its history. And as you can see here, each time Bitcoin approaches its 200 period moving average, it is a generational buy opportunity. It is a time that when you look back, you will be considered a genius. Okay. And what I suspect here, guys, is that this will be something like what we see in the future, right? And so this area will be looked back as being similar to this area, which will be looked back, which will be seen as similar to this area, which will be looked back, which will be seen similar to this area, and so forth and so on. And so what happens between, well, I should do it the other way. What happens between these periods, guys? All right, you got another one here. So what happens between these periods, you can't let that fool you, right? So you can't let the in between periods where the volatility is take you off of your game. This is the key to building wealth in an asset that is going through S curve adoption. I did this with I did this with Microsoft. I did this with Apple. I did this with Amazon. I did this with Tesla. I did this with Nvidia. I did this with gold all the way back. I'm doing this with Bitcoin now. All right? You've got to focus on the lows. Everyone focuses this way. Let me show you. They focus on Bitcoin going from high to low and then they think it's over. They focus on high to low, high to low, high to low. This is wrong. This is a novice view of the market. A professional grew, a professional focuses on the lows, not the highs. So, in essence, guys, it's the lows, stupid, not the highs. I'm going to repeat that. It's the lows, stupid, not the highs. I don't say that in a derogatory way. It's just, as they say in Spanish, un dicho. It's a saying. It's the lows, stupid, not the highs. Forget the highs. The highs don't count, right? So if we look at the lows, look at what you have here. Look at the lows. Sorry. Look at the lows. Okay, let's go over them. Low, all right? Low, low, low. Every major low is higher. You can get tricked by focusing on the highs. That is not how you play an asset that is being adopted through an S curve. You focus on the lows. And one easy way to do that is with the 200 period weekly moving average. As long as that, all right, is rising to flat, you're okay. Now, uh, I believe that we are once again near, we are once again near one of these generational buy zone areas, and that your future self will reward you. All right. The macro environment is applying pressure, but that is only a gift because had this not have happened, you would be asking me about whether to buy Bitcoin at $110,000. Oliver, is it still a buy? So be glad that this is happening. This is giving us more time to accumulate the rarest asset in the world. And increasingly so, this will be the case. This one last thing I wanted to show you here is this. Remember, I told you that Bitcoin makes everything go to zero. So we can take something like, um, let me just show you this. The average, I went over this earlier today with some of my traders, right? Check this out. Let's do it over here. In 1916, the average price of a home in the United States was roughly $350, $350,000. Now, in the, I'm gonna bring my calculator up here, guys. Okay, let's do this together. I'm gonna show you this. Check this out. So, average price was $350,000. I'm gonna take that number, and we're gonna go back to 2016. All right, let's find out in 2016. Let's pick a price in 2016. All right, so let's pick $250 in 2016. Well, that's 15. All right, let's pick 250,000 in 2016, right? So $250 Bitcoin price, right? 350,000 divided by 250. You needed 1,000 would cost you, what am I doing that? You needed 1,400 Bitcoin to buy this house. That was your cost, not in dollars. Your cost is in Bitcoin. It cost you 140 Bitcoin. In the year 2022, this $350, I know that's not the current value of the home, but let's work with that. That same $350,000 home, provided that the price stayed the same, is now, all right, at 30,000 divided by 30,000. Your cost now in Bitcoin terms is 11.6 Bitcoin. Now follow me. If you denominate in Bitcoin, not in dollars, okay? If you denominate in Bitcoin, not in dollars, Your cost went from 1,400 BTC to 11.6 BTC. This could in the future go to 5 BTC, then 2.5 BTC, then 1 BTC, then a half a BTC, then a quarter of a BTC. Do you follow? So when you denominate in Bitcoin, you see how safe storing in Bitcoin is, because by storing in Bitcoin, the number of Bitcoin you need to buy the same thing later gets smaller over time. 1,400 to 11, and it's going to get smaller and smaller. Now, some people might say, well, Oliver, we know that the price must have doubled, and this is very true. So let's take a $600 price, $600,000 price now. All right. You take a home in America, $600,000. Okay. And you take that and you divide it. Let's say you bought a $600,000 home in 2016 when Bitcoin was $250. It would cost you 2,400 Bitcoin in 16. Today, that $600,000 home divided by would cost you 20 Bitcoin. So what's the point here? You've got to stop denominating in US dollars, because guys, and if you denominate in US dollars, your price always goes up. So if you store in US dollars, your $350 home becomes later you need $600, 600,000. Your $350,000, now you need almost double 600,000 to buy the same home. But if you denominate in Bitcoin, it costs you 1,400, but later only cost you 11. So which is safer, to hold your reserves in an asset, US dollars, that makes everything more expensive in the future? Or is it safer, despite the volatility in between, is it safer to hold your reserves in an asset that makes everything go to zero, become less and less and less and less? Of course, that's the safest. People get fooled by what the dollar says the value is. So you want to see some real life examples of Bitcoin making everything go to zero? Here's a cryptocurrency called Bitcoin Cash. Take a look at this. Here's Bitcoin Cash, right? A BS cryptocurrency, by the way. This is Bitcoin Cash's history. This is its initial run up. We know that every new coin runs up when it first gets issued. That's a given, right? That means nothing. Since then, no new high. All right. So we get this. This is the effect. High. Shoot, did I drop the live stream? No. Why am I getting a call in the middle of my session? Hello? I'm doing a live now. Is this important? My goodness. How can my staff members not know I'm doing lives here? Wow. 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 All right. That person will be hearing from me. You know that. They should be here, right? Okay. So Bitcoin Cash here. Boom. We drop, and look, we go to a lower high and then we drop. What do you think is next? A lower high and we drop until this goes to zero. Now, this is looking at Bitcoin Cash in US dollar terms. Look at it. Look at it here. We're judging the value of Bitcoin Cash using the US dollar. This is judging against a weak asset. The dollar is a weak asset to judge by. So if this is weak, even with the US dollar as its denominator, this is a piece of junk, right? So check this out. Now, if we judge Bitcoin Cash in U in BTC terms, this is what Bitcoin does to everything on planet Earth is it sends it to zero. You see the difference in judging an asset in dollars versus judging an asset in Bitcoin denominated terms? You begin to start to see how safe Bitcoin is as an asset. It's not that your dollar is not safe. Here is Bitcoin. Here's what Bitcoin is doing to the US dollar. Look, when we look at Bitcoin here, this is what Bitcoin is doing to the US dollar. Look at it's killing the US dollar. This is judging Bitcoin over time using the US dollar. Look at it at the top Bitcoin in US dollar terms. What is it telling you? It's killing the dollar. Do you understand? It's killing the dollar. And if you judge, I don't even know if I can see USD in BTC. Can I see USD in BTC? No, that's not possible. If we judge something like even gold, say UBTC, can I look at that? If we look at gold priced in Bitcoin, look at what it does to the price of gold. People think that gold is safe. Well, gold is safe in US dollar terms. But when you judge gold in Bitcoin terms, it's sending gold to hell. Do you understand? Bitcoin is sending gold to zero, like it's sending real estate to zero, like it's sending stocks to zero, like it's sending um, other cryptocurrencies to zero. Everything goes to zero against Bitcoin, making it your safest store of value because the poor stores of value have very little volatility. They just bleed you dry so slowly you don't notice it for 10 years. They regard that safer. You can't do this. You can't make this error. So if you get in the habit of looking at everything through the eyes of Bitcoin, you see how it is eating the world. It is destroying the world, traders. Do you understand this? You can put anything up against Bitcoin, denominate it in Bitcoin, and make your judgment, and you're going to see it is trouncing everything. Now, I'm not the only person in the world who knows this. And every single day, more and more people are becoming aware of this until adoption reaches a certain point and this thing freaking explodes away from you. So it is mine. This is not financial advice. I'm only some guy on the internet, guys. But I will tell you this I will tell you that I have never seen in my 40 years playing the markets, 36 of which as a professional. I've never seen an asymmetric bet like this. I've never seen where I've got 20% downside risk, but I've got 213% upside gain potential. Never, never, never. I've never seen an asset adopted at the rate that this asset has been. There's never been one in history. I've never seen something with the performance of Bitcoin. There's never been another asset that has ever performed like Bitcoin. I've never seen a network that's never been hacked. There's never been a network that hasn't been hacked. I've never seen a network that's never down in the last 10 years has never been down, not even once. I've never seen an asset trade 24 hours, 7 days a week, 365 days a year. Bitcoin does that. I've never seen an asset go from zero to $69,000 in 13 years with 1.5% adoption. What? 0 to 69,000 with 1.5% adoption, meaning 1.5% of the world has discovered Bitcoin, and it went from 0 to 69. Where do you think it's going to be with 3% adoption, 5%, 8%, 10%, 20%? Oh my God. And never in history has a digital form of an analog item stayed lower than the analog item. There's a digital phone. Here's a Samsung Galaxy Fold G, 3G, Galaxy Fold 3G. I think that's what it's called. It's a $2,000 phone. All right. That's a digital phone. S- The analog version of that phone is a phone with a wire attached to a wall. Do you remember those? It'll take the phone off the wall, dial the numbers. All right. Sometimes the cord would get wrapped around your hand and stuff. You had to undo the cord. Maybe maybe I'm dating myself. Maybe none of you remember phones like this. But anyway, the digital version is 2000. That phone today can be bought for $37. There's an exponential increase in the value of the digital version versus the analog version, right? Okay? Same thing with digital mail. When we used to write letters, write the address, lick disgusting stamps, put the stamps on the letter. Am I dating myself? Nobody here did this? I'm just old like that. And go to the mailbox and mail it. How many letters? What was the volume of letters per day? It was in the hundreds of millions. Now we have digital mail, email, hundreds of millions analog, billions per minute. The volume and value from the digital is exponentially higher than the analog. Gold, analog, it is a freaking rock. All right. Gold is analog, traders. Okay. Gold is analog. Take a look at this. This chart is of analog gold priced in Bitcoin. But get this. Check this out. This is gonna rock your world a little bit here. Now, I'm gonna show you. uh, Here is gold having run up all the way, boom, 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 boom. Very impressive. Right into 2011, making its top, right? In 2011. That's what gold did. Had an impressive run. I rode that gold up. Many people who followed me made a fortune off of gold because it was the number one thing I was banging the table on back then. Now, check this out. Bitcoin is born in 2009, trades at a zero cost until guess where? Bitcoin trades at a zero cost. It's just mined and it has zero value until when? Until its first price right here. Do you see that? Once Bitcoin gained a price, guess what gold started doing? Because the digital form of gold, the baton has been passed to the digital version. Like the analog phone was passed to the digital phone. Like sending physical letters, the baton for that was passed to email. Like vinyl records was passed to streaming. VHS videotapes was passed to streaming. Do you understand what I'm saying? Lanterns used to hold lanterns to light your house, physical light to walk around your house, to light your house, to now you can't even touch electricity, the digital form of energy, right? Everything goes to digital. Now, check this out. We Look at when this happened. 2011, gold topped. That's when Bitcoin gained its first price. Now let's go back to 2011 here in BTC. I got to get the right one here. It's 2011 here. Look at the year, 2011, and boom, it takes over for gold. Now remember, gold is going down during this period, right? You see what I'm saying? Gold is going down during this period and only starts to regain here, but that's just temporary. It will never outpace its digital version again, ever. The same way phones with cords will never compete with this again. The same way physical letters will never compete with email again. The same way libraries will never compete with digital books again. The same way vinyl records will never compete with streaming on Spotify again. The same way physical movies you held in your hand in VHS form will never compete with Netflix again. Do you understand? The digital version of an item always exponentially replaces the analog version. Gold is $12 trillion. Bitcoin, its digital version, is 600 billion. So tell me, if this theory is right, and it is, where is this value going? If the digital version never stays below the analog version, and the analog version is 12 trillion, and the digital version right now is a baby at 600 billion, where is this going? It is going way past 12 trillion. Now, some traders say, well, Oliver, won't it just go up to gold's value and stop? Well, did this go up to the value of the phones with a cord and stop? Or did it keep going up? Did an iPhone start at 300, then 400, then 500, then 600, then 800, then 1100, then 1200, then 1500, right? So it didn't stop at the value of the analog. So if gold is 12 trillion, Bitcoin's future value must be exponentially greater than 12 trillion. And so this is not a bubble, this is a baby. The people who are calling Bitcoin a bubble have no concept of what I'm explaining to you right now. 1.7% adoption is not a baby. It's not a bubble. It's a baby. 13-year-old asset is not a bubble. It's a baby. Do you understand? And that's my thesis on Bitcoin, guys. Um, I'm still a baby with this myself, guys. I'm still learning. I'm still going deeper and deeper down the rabbit hole. I believe my knowledge about Bitcoin will just only deepen and deepen every single week. But I feel it is an obligation with my followers, with my traders, and those I care about to share what I'm learning and what I'm seeing. Because in my 40 years of playing this game, I've never seen something like this. All right. And I think it's my fiduciary responsibility, if you trust and believe in me, to help you see what I see, and then you make your judgment. Okay. But if this resonates with you, go out today and pick up some Bitcoin. All right. Put just even a little bit in, just in case I'm right. Traders, I love you very much to death. We went a little bit over time today, and I think Bitcoin's the culprit here. It always basically is. But listen, guys, thank you very much. Thank you for joining me. Thank you for supporting these live sessions, guys. I love you to death. Please hit the like button, subscribe to the channel, turn notifications on. Right? I do want to make you aware, guys, of something very special here, if I can. Um, I actually almost forgot this, but I'm in my beloved Medellin, Colombia, right now. And I am having a very special I'm having a very special event here this weekend. And for those of you who are able to join me here, I just want to show you this because I have I have a lot of followers who will just jump on a plane and come anywhere. And I love that. I love that. But if I can find this, let me just do it this way. I will just do it this way and show it to you this way. Be a little bit sloppy here, but here you go, guys. Um, this is I'm having a live trading camp, right, in Medellin, Colombia, here this upcoming weekend, 4th, 5th, and 6th. In this event, guys, this is where I cover my 20-minute trading specialty. I want every single one of my traders to be experts at making their living in the first 20 minutes of the trading day. They can trade all day, but I just want them to have the ability. I want trading all day or trading more than 20 minutes, 30 minutes. I want it to be as an option, not as a necessity, because this activity is about freedom. And sitting in a chair staring at a screen all day is really still just a digital form of the same thing you do for a boss, even though you're doing it in your home for yourself. It's a better version, but it's still a slave oriented version. I want you to be able to spend the vast majority of your day doing whatever it is that tickles your fancy, that uplifts your heart, because you can support yourself playing this game 20 to 30 minutes of the trading day. And so this event is what focuses on that. But what's special here is that we're also having a trading camp for the kids of the parents. And so a lot of people aren't aware of the fact that I have a trading kids program. We have hundreds and hundreds of children from kids from all over the world learning how to professionally, efficiently trade the markets. Many of the kids go on to be funded after they're of age and have gone through training. Imagine a child starting at 10 or 12 years old, where they're going to be at 18 years old, 20 years old, 21 years old. Wow. So I always say start them young. And so this is the first event where I'm combining the two. I'm having the live trading account for the adults, and in the room next door, their children are going to be going through their version of the live trading account. And so parent and child will be learning side by side. I think that's very special, guys. And so if you happen to be in town or willing to come to town, this is going to be a very special event. You can find more information on that. The seats are extraordinarily limited right now. TourOliverVelez.com. I didn't do this in Brazil. I did the live trading camp in Brazil last 2 weekends ago, um, but not with the kids, but with the adults. But this one is extra special because it does involve the kids. So very important there, guys. So listen, once again, thank you very much. I will take this off here. Thank you very much for joining me here. Enjoy the rest of your holiday. The market is open tomorrow. The U.S. equity markets are open tomorrow. We'll be back at that game tomorrow morning. Ciao for now, guys. Love you to death. Boom, boom, boom. And I'll see some of you in Medellin this weekend. Yeah. And another one. Another one. Love you guys. Love you. Ciao.